Well, we've got a pretty short topic here on an overview of portfolio management. So here we're going to take a look at types of accounts to be managed. We'll take a look at some of the various forms of pooled investment funds and also the steps in the portfolio process. Very much an overview and an introduction. Now the real portfolio management stuff, of course, happens at level 3. But we'll introduce it here, some concepts, certainly not hard to understand and remember. The first thing we want to talk about is the portfolio perspective, though. Now, it used to be, back in the day, every investment would be looked at in terms of its risk, and that had to be suitable to the client. So if you had a retired client with low risk aversion, you'd talk about top-rated bonds, you'd talk maybe about some blue-chip dividend-paying stocks. But with the change to modern portfolio theory, now the investment manager looks at the overall portfolio, and in adding any investment, any asset, any security to the portfolio, looks at its effect on the portfolio risk. It's the risk and return of the portfolio as a whole which must be suitable to the investor. Now it turns out that adding a risky asset can actually reduce portfolio risk because of diversification. As long as the returns aren't perfectly correlated, then adding another asset, even a riskier asset, at least in some measure, can reduce portfolio risk. One of our measures of the benefits of diversification is the diversification ratio. And that's the standard deviation of portfolio returns over the average standard deviation of returns on portfolio assets. So if we take all the assets in the portfolio, look at their average standard deviation without any diversification benefits, and then put together an equal weighted portfolio of those assets and look at the standard deviation of portfolio returns, that diversification ratio, the lower it is, the greater the benefits of diversification. Now if I can grab my pen here, make this slide change. There we go. We can start talking about the various kinds of investment accounts that a portfolio manager may have to take care of. First off, pension plans. We've got two types here. A defined contribution plan. That's like a 401k or a 403b in the U.S. There's no guarantee of future payment, and the individual bears the risk and makes the decisions. So it's a plan that's set up. Some of these employees' wages or salary can be sent to this plan, and then the investor, the employee, makes the decisions on what's going to be in there. Now usually through a choice of some mutual funds that are appropriate for a retirement account. Now in a defined benefit plan, there's actually an obligation by the employer for future payment. Has a long time horizon, risk tolerance is high, and the income needs really depend on the age of the beneficiaries. If you've got a young workforce still contributing to the plan, then the income needs are very low, and the liquidity needs are typically low. It's fairly easy to predict what the benefits are going to be, what benefits are going to need to be paid out over a number of years into the future. But with a defined benefit plan, it's the employer that sets the money aside, the employer that has the obligation. So it may say, well, take 80% of the highest salary paid, and that will be paid for life in retirement. So that's the liability, that's the obligation. And the management of the plan is to manage the assets in such a way as to meet those obligations in the future. An endowment fund usually set up for some charitable giving or some specific purpose, like funding a university. So providing ongoing financial support for some reason. The time horizon here is very long. Hopefully the endowment fund will last for many, many years and are managed with that in mind. The risk tolerance fairly high and the income needs fairly low. Just what's going to be distributed on an annual basis. And it's the same point with the liquidity. There's not going to be any real surprise needs for liquidity. The endowment usually has some spending target and some growth to support that. And very often that spending target is to spend the same amount in real dollars over time. So to grow it in pace with inflation and produce an annual support. Now the next one we want to look at here is insurance companies, and we want to look at two types here. We can have property and casualty companies like homeowners insurance, car insurance, things like this, and life insurers, and they have a little bit different needs because the time horizon is fairly long for life insurance companies and short for property and casualty companies. Property and casualty companies expect to pay out on an annual basis a significant amount. Now there's going to be some surprises there, so the liquidity needs are high and the risk tolerance fairly low. People who pay for their insurance are looking for safety and stability in a company's ability to meet its liabilities. Income needs low. The liquidity needs are there to pay the claims, but other than that, the ongoing income needs are not significant. Another type of investment portfolio is a bank, and for a bank, the loans that the bank makes are its assets. There are excess reserves that can be invested in fixed income securities, and primarily money market securities and fairly low risk fixed income securities. Because we see for banks here, the risk tolerance is low and the time horizon is relatively short. Now the bank's portfolio needs to generate income because they have to pay interest on their deposit accounts, their certificates of deposit. And the liquidity needs are high because the bank has to stand ready to pay back depositors if they choose to withdraw their money. Now clearly the bank's loan portfolio is not particularly liquid, but their securities that they invest in should be. Other types of investors that we need to consider here, one is mutual funds, which we'll talk about more on different sections and later in this section. But mutual funds, liquidity needs are high. They have to be able to meet redemptions if customers decide to redeem their shares and take out their money. Now the time horizon, the risk tolerance, and the income needs really depend on the type of fund and the fund objective. Sovereign wealth funds, there's some very large sovereign wealth funds, and they have various investment goals. Some of them invest for the benefit of future generations. Some of them manage the foreign exchange reserves of their countries. Some of them manage government assets, that is, they take care of the state pension plans. So we get a bit of variety there in these sovereign wealth funds. Now let's look at the portfolio management process and the steps. And the first step is, of course, the planning step. First off, we need to understand the client needs and constraints. And our key document here is an investment policy statement, or IPS. So we look at the client's needs, constraints, characteristics, risk tolerance, all of this, and then we develop this investment policy statement and then a strategy that's consistent with the goals and constraints in the investment policy statement. Also during this planning process, we need to specify a performance benchmark. How are we going to measure the manager's performance? And that benchmark should suit the universe of investments that the manager can choose from. So usually that's an index, a passive index, and said, well, if there weren't any selecting going on here, if there weren't any active management, what could we have earned just by investing in an index or a specific asset allocation of index portfolios of various asset classes? Better not skip to 3. Number 2, the execution. Now, once we've determined the needs and we've got a strategy in place, now we need to analyze the risk and return characteristics of the various asset classes. Look at the market conditions and possibly identify some of the more attractive asset classes. Within these asset classes, if we're pursuing an active management strategy, we can identify the securities that we think are best price or offer the best returns given their risk characteristics. And then finally, we need to construct the portfolio. Now our asset allocation, we've got our target asset allocation. That's the asset allocation to various asset classes that meets the risk and return characteristics and the constraints that we've identified for the client. A strategic asset allocation is a deviation from the target allocation based on the manager's understanding of the current opportunities in various asset classes. So, say our target asset allocation to bonds was 30%. If the manager feels that bonds are right now a very attractive investment or asset class, then they could increase that to say 35 or 40%. Within the document, there's going to be guidelines as to how far from the target allocation the investment manager can vary in creating the strategic asset allocation. And within these asset allocations, then we need to choose individual security weightings. Now, in a passive strategy, that could be the index weightings, but in an active strategy, the investment manager will identify attractive securities within these asset classes to try and generate extra returns that way. And also the risk management. What's the risk of the portfolio? How are we measuring that? And is it within the guidelines that we established in the investment policy statement? The third step is the feedback. We need to monitor and update the investor's needs over time. If there's changing circumstances, we need to address that. But we also need to look periodically just to check and make sure that those needs haven't changed. Then we need to look at and update market conditions. If we thought bonds were a good investment a year ago, but they've appreciated significantly and we don't think that anymore, then we've got a new view of market conditions, and this should be reflected in our strategic asset allocation. We also need to rebalance the portfolio. If we had a 35% allocation of bonds, and bonds did very well while stocks did poorly, we might find that we had 40 or 43% of our portfolio invested in bonds. So we need to take this back to our strategic asset allocation, or if we're not pursuing a strategic asset allocation, we need to rebalance periodically back to our target asset allocations for the various asset classes. And finally, we need to measure performance and report performance relative to that benchmark that we established in the first part of the investment policy statement. Finally, we need to look at various types of pooled investments, pools of investor money. And the first one we're going to look at here is open-end mutual funds. Now, open-end mutual funds, you purchase or redeem the shares at net asset value directly with the fund. You send in money, they issue new shares representing shares in or slices of the fund. And when you decide that you want to liquidate your position, you redeem those shares also with the fund management company. So the number of shares in the open-end mutual fund changes with purchases and redemptions. If more money comes in than redemption, it grows. If there's more redemptions than new purchases, then the pool will get smaller. And that's why we call this open-end, because funds can flow into the fund or flow out of the fund. The fees, there's a percentage for ongoing management. So that's going to be a little higher for equities, a little lower for fixed incomes, and even higher still usually for international or global funds. There can also be sales fees. With load funds, there can be an upfront charge, a percentage of your investment, or there can be a redemption charge. A redemption charge usually declines over time, and a typical structure would be, well, if you redeem the shares within the first 5 years, you pay 5%. After 1 year, that drops to 4%, and then 3%, and then finally, after 5 years, goes to 0. So that's typical of a redemption charge. Upfront charges are not as popular as they once were. But there are also funds that are true no-load funds. They don't have upfront or redemption charges. Now, they still have the ongoing management fee, but there's no sales fee that's being paid to a salesperson, so you need to go directly to the fund to do business with them, and it's usually not done through a sales agent or a broker. Closed-end mutual funds, don't have money flowing in and flowing out. They're set up with a fixed number of shares and issued as an initial public offering. So say they're going to raise $10 million, sell 1 million shares at $10 a share. That's going to be the pool of money, and that's going to be the fixed number of shares, 1 million shares. Now, once the initial public offering takes place, these trade just like shares of stock. You buy them with a commission. There's a bid-ask spread. You can buy them on margin. You can short them, and you can trade them any time of the day, any time the market's open. Now, the management company still gets a fee for the ongoing management of the portfolio, just as with an open-ended fund. But market prices can, and very often do, differ from net asset value. Net asset value being the total value of the securities in the portfolio, their net value, net of any liabilities, divided by the number of shares. But market prices can be higher than this, trade at a premium, but very often they trade at a discount from net asset value. Now, in terms of managing the money, for a closed-end fund, they don't have to stand ready to redeem shares. If a holder of closed-end fund shares sells their shares, they're just selling them to another investor. The pool of investments is unaffected by this. So they don't need to hold cash. They don't need to sell shares to meet redemptions. So they have much less of a need for liquidity. When we look at mutual funds, we very often divide them by their investment objective. A money market fund holds very short-term debt securities with average maturities in the 30, 50, 60-day range. And bond funds can be differentiated based on the type of bonds that they hold. We can see high-yield bond funds, global bond funds, domestic bond funds, purely government bond funds, corporate bonds of various ratings, long-term or short-term bond funds, or even tax-exempt bond funds that hold municipal bonds in the U.S. We can divide stock funds into two general categories. One, are they actively managed, or are they index funds? Now, index funds try and match a particular market index in terms of performance, often by holding exactly the index stocks. In actively managed funds, the manager is trying to beat the market. He's trying to generate extra returns through security selection. Balanced funds simply refers to funds that hold both fixed income investments and equity shares. And we talked about open-ended and closed-ended funds. More recently, there's been a great rise in the popularity of exchange-traded funds. Now, most of these are index funds. They're typically index funds. And they trade on exchanges or over the counter like shares of closed-end funds or like any shares of stock. They can be shorted. They can be purchased on margin. The dividends on these are typically paid out. With an open-end fund, reinvesting the dividend in additional shares of the fund is easy. That's more difficult with a closed-end fund or with an exchange-traded fund. Now, let's contrast these with a closed-end fund because the added feature, the most important added feature for these ETFs is in-kind purchase and redemptions. And the idea of this is to keep market price close to net asset value. The way this works, there are participants who are allowed to give the ETF shares of the underlying stocks held in the index fund in exchange for shares at their net asset value. Or you can redeem your shares of the ETF and get the underlying shares from the ETF. Well, this gets rid of any tax consequences, so this gives them some tax advantages. Even if there's these kinds of redemptions, they're not selling the shares and realizing gains and then passing through the money. They're actually distributing the shares, so they avoid some tax potential for taxation there. So through this in-kind purchase and redemption, it keeps the price very close to net asset value. Think about it for a minute. If the ETF price gets above net asset value, then I would want to get the underlying stocks at net asset value, exchange them for ETF shares, which I would sell, and keep the difference. On the other hand, if the price were below net asset value, then I would want to buy shares of the ETF below their net asset value, exchange those for the underlying shares, and then sell the shares to realize net asset value. Separately managed account, these are accounts just owned by a single owner. Now usually we're going to have higher minimum investments on these, and actually $100,000 would be pretty small, but minimums around $500,000 are not uncommon. They're also called wrap accounts because the management fee and the trading fees are all wrapped into one as far as managing this account. But it's managed for a single investor so it can meet that investor's needs, hopefully with some diversification, whatever the income needs are, and also can be managed with the investor's tax situation in mind. Now, buyout funds are pools of investor monies where they take companies private. They buy all the public shares, and then it's not a publicly traded company anymore. You're not under the obligations that the SEC or the securities regulators in whatever country you're in put on publicly traded shares. Now typically they use a lot of debt, and you hear the terms leveraged buyout or LBO quite a bit. Sometimes we hear MBO or management buyout. That's just a buyout where the current management of the company is a significant part of the buyout group. There would be ownership of a significant part of the company once it's taken private. Now the idea here is to restructure it, improve the cash flow, often redo the incentive structures to properly motivate management to grow this company, grow its cash flow, very often pay down debt over a period of time, and then resell the equity as an initial public offering at some point and make a lot of money on the deal. At least that's the idea. The last two we want to look at here are venture capital funds and hedge funds. When we talk about venture capital funds, we're talking about providing startup financing, early stage financing. Sometimes we call that seed financing because you plant a seed and it grows. So very early on, and these are very risky investments. They expect many failures, but they expect their successes to be very, very big. And also venture capital funds are active in the management of their portfolio firms. Often they'll have expertise in one particular business area, maybe technology, maybe the healthcare or healthcare management field. And so those are the areas that they'll specialize in. And they'll have people, they'll have partners that have been operating officers or CFOs of these types of companies, have good contacts in the industries, and can help with recruiting of management talent or just sit on the boards and guide these companies and try and grow them into successful entities. Now, hedge funds are less regulated than mutual funds or ETFs or anything that's sold to the public because they're not registered or offered to the public. They're sold under laws which permit them to be sold to a small number of accredited investors. Accredited in terms of having enough money and having enough liquidity that these hedge fund investments, which are often very illiquid, are suitable for them. They have a high minimum investment amount, often very high leverage, and more recently have gotten leverage by using derivatives as well. So when they were first named, these funds used to hedge market risk. Not the case anymore. There's many strategies across the board, and most of them have high leverage and a fairly high degree of risk. Some examples here are a long-short fund. This takes out some market risk, and they're actually hedging a little bit. But if we talk about a global macro fund, that's a fund that's trying to make bets on macroeconomic movements around the world, maybe with big leveraged bets on currencies, being short the euro and long the yen. So these are not really hedge strategies. These are quite risky strategies. When we talk about an event-driven strategy, we're talking about something driven by a particular corporate event. And oftentimes, if that corporate event has to do with issuing other shares or convertible shares and things like this, they'll do some sort of arbitrage based on that. So this is our overview of the portfolio management process.